Yeah, hearty welcome.
Uh, Can I start, sir?
Yeah,
Hearty welcome to the Study Circle on Income Tax Act 2025, Lecture Series 2. We are pleased to welcome all faculty members to today's virtual session on residential status, a key concept under the Income Tax Act 2025. We wish you an informative and enriching learning experience. With this, I now hand over the session to our resource person, CMA Rakesh Shankar, sir. Over to you, sir.
thank you. Thank you, Vaishnavi. So, hearty welcome to all the participants for the Study Circle on Income Tax Act 2025, the second lecture series on the residential status. So, we have heard about the overview of the residential status. Again, basically, it is the section 6, so which plays a very no prominent role in the in deciding the nexus of taxation. So the Income Tax Act 2025 retains a fundamental residential status framework, substantially unchanged from the earlier law. The rules are almost the same, but we have some small no differences we have got. So otherwise, majority it remains the same. So at the end of the session, you'll be able to explain the concept of residential status under the Income Tax Act 2025, apply the basic test for determining the residential status of an individual, distinguish between resident and ordinary resident, resident but not ordinary resident and non-resident, and apply special provisions applicable to the Indian citizens and persons of Indian origin, POI who is visiting India. So understand the deemed resident provisions, and again go through the concepts of residential status of HUF, firm, AOP and companies. So apply the residential rules to practical situations involving foreign employment, and also understand the relationship between the residential status and the scope of taxable income. So if you talk about the residential status is important for determining the taxability of income in India. Residential status is different from citizenship. Maybe you could be a citizen of some other country, but you can be a resident in India by satisfying the conditions. An Indian citizen, if he is staying so many number of days in abroad, foreign countries, he can be a resident of that particular country, their taxation laws. So a person can be a resident in more than one countries in a financial year, or we can call it as a tax year. Now, residential status is not the same as citizenship or nationality. Residential status is only for determining the scope of taxability of income in the country. So a person may be an Indian citizen, but he may be a non-resident for income tax purpose. Similarly, a foreign citizen may be a resident of India. So if the prescribed conditions are satisfied. So the residential status is determined separately. If you look at the basic conditions based on the number of days stayed in India, the previous year stay in India, the nature of employment, income earned in India, the foreign source income, taxability in another country, past residential history. So these are the factors which determines the residential status of an individual. Now, for an individual, what are the categories of residential status? A resident individual may be further classified as an ordinary resident or a not ordinary resident, or he can be a non-resident. So there are only two options, either be a resident or a non-resident. If you are a resident, again, we need to check whether you are an ordinary resident or simply a resident, or you call yourself as a resident but not ordinary resident. So to test this residential status, we have certain basic test and the special test to be applied. Basic conditions which are prescribed under section 6. An individual is treated as a resident in India if either of the following basic conditions are satisfied. Either, so any one of the basic condition is satisfied, either condition 1 or condition 2. The individual is in India for 182 days or more during the relevant tax year. Look at the word here. It is substituted with the word tax year. So you should have stayed in India for the tax year 2026-27 for a period of 182 days or more. The second condition is the individual is in India for 60 days or more during the relevant tax year. And here we have one more condition. So if 182 days is not satisfied, immediately look for 60 days. And in the preceding 4 years, the person should have stayed for 365 days or more in the preceding 4 tax years. So what is the second condition? In the current tax year is 60 days. And in the previous 4 years, it is 365 days or more. So when you do this test, so stay in India is greater than or equal to 182 days, or the second test is stay in India is equal to or greater than 60 days, plus additionally you should check for 365 days. If the second part of the condition, the 365 days is not satisfied, then automatically you'll have to take the person as a non-resident. So if the test is satisfied, he will be a resident. If the test is not satisfied, he will be a non-resident. So it is retained in the same section 6 of 2025 Act. Now, if the individual has stayed in India for 182 days or more, so immediately go for a second test, the additional test to determine whether the person is a ordinarily resident or a non-ordinarily resident. So in the second step, just check whether the person has stayed in India for 60 days and then in the last 365 days when you check, you decide whether a person is a resident or not. Now, a person has stayed in India for 60 days. He left India for the purpose of employment. Here the word employment we'll have to consider with what is stated in the act. It says for the purpose of employment. So when you just look into the word for the purpose of employment, so whenever a person is leaving India for the purpose of employment, that 60 days test is replaced by 182 days test. So if a person has left India for the purpose of employment, then we'll have to substitute that 60 days with 182 days, which means the first condition has to be satisfied for the people who are the Indian citizens who are leaving India for the purpose of employment. The second condition is, it's a special rule. So special rules apply to the Indian citizens visiting India. Why Indian citizens visiting India? So Indian citizens are residing abroad in a country, maybe for their PR or for maybe for the country citizenship, they are residing there. They are visiting India, or persons of Indian origin. So we call them as POI or PIO. They have a POI card. When they visit India, their stay should be in India for 182 days or more. When the stay is in India for 182 days or more during the relevant tax year, now there is one special rule which says, now if that special rule says if they have Indian income of 15 lakhs, other than the foreign sources, they have some house property, deposit income. So when they have other sources income, which is exceeding 15 lakhs in India, now the alternate test, that 60 days will be replaced by 120 days. So this is a special rule for the Indian citizens who are visiting India, or the persons of Indian origin who are visiting India, that their stay in India is more than 182 days in the relevant tax year. So automatically they become resident. Now, deemed residential status, now we'll have to check if a person who has not stayed in India for 182 days, if he or she is having the special income, that is income of 15 lakh from the other sources, or other sources is not. So when you talk about that other sources. So in that case, normally what happens is it could be your business property or no whatever you call. It could be house property or business, or it could be your no bank interest and all. So in such case, this 15 lakhs rule will apply. Next, deemed resident. A special rules applies to an Indian citizen. The total income other than the foreign sources exceed 15 lakhs, and the person is not liable to pay tax in any other country or territory by reasons of domicile, residence, or similar criteria. So when you are not assessed to tax in any other country, so automatically you become a deemed resident in India. Next is resident but not ordinarily resident. So an individual is generally a resident, not ordinary resident, if either of the following conditions are satisfied. The first condition, the individual has been a non-resident in India in 9 out of 10 preceding years. The next one is the individual stay in India during the 7 preceding years is 725 days or less. So when either of the two conditions, like you fulfill, you become a resident and not ordinary resident. So we have this condition 1 or the condition 2 here. Again, it is as per section 6, subsection 13 of the Income Tax Act of 2025. So we now, like, what is it we do is, we just check for basic conditions, and if basic condition is satisfied, you become resident. If basic condition is not satisfied, then automatically what happens? You become a non-resident. So the assessee, when he is declared as a resident, you check for whether he is an ordinary resident or a not ordinarily resident, where we will have the special provision of this 15 lakhs and that 120 days test. The 60 days is replaced by 120 days test. So this point number 11 will give you a comparison of the various factors. What is it you determine? Just for referencing. Next is the residential status of other persons. An HUF is resident if the control and management of its affairs is situated wholly or partly in India. However, again, the HUF can be declared as an ordinary resident or a not ordinary resident depending on the statutory conditions which is applicable to Karta and the past residential history. So again, HUF is completely, it is determined by the control and the management of its affairs, and the residential status of the Karta will have an influence on the residential status of other persons. Next, a firm, AOP, or a body of individual. So if their control and management of the affairs are wholly or partly in India, then they are called as resident in India. If the control and management is situated wholly outside India, then they become non-resident. Only for the individuals and the HUF, we have the additional conditions for resident. For all other classifications of the assessee, either they can be a resident or a non-resident. So when you again talk about the company, a company is resident in India. First one, if it is an Indian company which is incorporated in India, or the place of effective management, in short we call it as a POEM. The place of effective management is in India. The speciality of this Income Tax Act 2025 is the place of effective management has been clearly defined by the Income Tax Act 2025. There's a clarity. How do you determine the place of effective management? So the scope of total income decides, it depends on the residential status. So for a resident or an ordinary resident, the income received or deemed to be received in India, income accruing or arising or deemed to accrue or arise in India, income accruing or arising out of India becomes fully taxable. So thus broadly, the global or the worldwide income becomes fully taxable for resident and ordinary resident. A resident and not ordinary resident is generally taxable on the Indian income. Foreign income from a business which is controlled in India or a profession set up in India subject to the statutory provisions. For a non-resident, income received or deemed to be received in India and income accruing or arising deemed to accrue or arise in India becomes taxable. So which means a foreign income that has no nexus in India is not taxable in the hands of non-resident in India. So let us look into the practical illustrations to understand the provisions better. Mr. A has stayed in India for 190 days during the tax year 2026. He has satisfied the first condition, 182 days, equal to or greater than 182 days. So he becomes automatically a resident. So the preceding 4 years is totally relevant. It is totally irrelevant because 182 days is satisfied. The first condition is satisfied. In the second illustration, if you look at Mr. B has stayed in India for 75 days during the tax year 2026-27. So you stay in India in the past 4 preceding years. So 22-23 is 100 days, 23-24 is 90 days, 24-25 is 95 days, and 25-26 is 100 days. So in the past 4 years, he has stayed for 385 days. So in the current illustration, Mr. B has stayed in India for 60 days, that is less than 182 days. So the second condition we'll have to immediately check for. So the first part of the second condition says he should have stayed for greater than or equal to 60 days. And he should have stayed in the previous preceding 4 tax years exceeding 365 days. So here in the current year, he has stayed for 75 days. And in the preceding 4 years, he has stayed for 365 days. So Mr. B is a resident here. So in the next illustration, Mr. C has stayed in India for 55 days. First condition of 182 days is not satisfied. In the second condition, the first part itself is not satisfied. So automatically Mr. C will become a non-resident here. Illustration 4. Mr. D, an Indian citizen, leaves India for employment in Singapore. So he stays in India for 150 days during the tax year 2026-27. So whenever a person is leaving India for the purpose of employment, only we'll have to check for 182 days test. The second condition, that 60 days is substituted with 182 days. So check whether the person has stayed in India for 182 days. Here, no. So automatically what happens? Mr. D becomes a non-resident. Fifth illustrations. Indians visiting India or the persons of Indian origin visiting India. Mr. E is an Indian citizen who is residing in US. So he has visited India for 100 days during the tax year 2026-27. So his income other than the foreign source income is rupees 12 lakhs. Since the income has not exceeded 15 lakhs, so the special provision of 15 lakh or 122 days provision is not triggered here. So we'll have to check for 182 days stay plus or that 15 lakhs of Indian income. So both the conditions are not satisfied. So he automatically becomes, Mr. E will become a non-resident in India. Illustration 6. Visiting Indian citizen with 20 lakhs income. So Mr. F is an Indian citizen who is residing in Dubai. So during the tax year 26-27, he has stayed in India for 130 days. His Indian income other than the foreign source income is 20 lakh. Stay in the 4 preceding years is 400 days. First condition, what is getting triggered here? He has got Indian income to the extent of 20 lakhs. So which is exceeding the specified limit of 15 lakhs. So now apply the test. So when you apply the test, automatically how many days of stay we should check? Whether he has stayed for 120 days or more. So he has stayed for 130 days. So that condition is satisfied. In the preceding 4 years, whether he has stayed for 365 days, yes, he has stayed exceeding 365 days in the preceding 4 tax years. So Mr. F automatically becomes a resident here. So you can post your queries in the chat box. So wherever possible, we will be able to answer all your queries. The purpose of having this session is to make yourself very aware of the relevant provisions to equip and empower yourself for this Income Tax Act 2025. Now, illustration 7, deemed resident. Mr. Citizen living in a country where he is not liable to tax by the residence of or by the reasons of domicile or residence. So in India, he has got an income of 25 lakhs. He has stayed in India only for 20 days, not that 120 days. And he is also not taxable in the other country. He is not a resident or he is not subject to taxation there. So in this case, since his income is exceeding 15 lakh, and he is not liable to tax in another country by reason of domicile, residence or similar criteria, so automatically Mr. G is deemed to be a resident in India. So here, this deemed resident concept is applicable only for the Indian citizens, not for the other people. Next, illustration 8, determining the resident and not ordinary resident provisions. Mr. H is a resident in India during tax year 2026-27. So he was a non-resident in 9 out of 10 preceding tax years. So the RNOR condition is satisfied. So he is a resident but not ordinarily resident. Next, so how to apply the 729 days test? The second condition of your special provisions for RNOR. So Mr. J is here 26-27. 7 years where 700 days. So since 700 is less than that, 729 days, the RNOR condition is again satisfied. So therefore, Mr. J becomes a resident and not ordinarily resident. Next, Mr. K is a resident in India in the tax year 2026-27. He was a resident in 9 out of 10 preceding years. He has stayed in India for more than 1,200 days during the preceding 7 years. See, during the preceding 7 years, the stay should be less than 729 days. So, he has been a non-resident in now 9 out of 10 years. He was a resident. So, no. Again, the second test is also whether he has stayed for less than or equal to 729 days. No. So, Mr. K is a resident and ordinarily resident. So, automatically this condition becomes valid. So, now we will have a case study. So, Mr. Raj is an Indian citizen who has worked in the UK for several years and returned to India permanently. During the tax year 26-27, he has stayed in India for 210 days. His foreign salary is rupees 30 lakhs. Indian interest income is 8 lakhs. He was a non-resident for 8 of the 10 preceding years. Stay in the 7 years is equal to 600 days. So determine his residential status. Is he a ROR or NOR? Discuss the possible scope of taxation of foreign salary. So the current tax year 2026-27, he has stayed in India for 210 days. So which is exceeding the specified limit of 182 days condition. So the first basic condition is satisfied. So he becomes a resident. In the second condition, he has been a non-resident in 8 of 10 preceding years. So condition of 9 out of 10 is not satisfied. Next one, stay in the preceding 7 years is 600 days. That is less than that 729 days which is prescribed. So Mr. Raj becomes a resident and not ordinarily resident. So since he is a RNOR, his foreign salary is not automatically taxable because it is taxable in the foreign country and he is a NOR here. Maybe if he has been a ROR, then even that foreign income will become taxable. Since he is a resident and not ordinary resident, so automatically he becomes a not ordinary resident and his foreign income is not taxable. Now, what do you mean by residential status? Just to have a recap, residential status determines whether a taxpayer is a resident or a resident and not ordinarily resident or non-resident for a particular tax year. After determining the residential status, we can determine the scope of the income which is taxable in India. Next, Whether the citizenship is same as residential status? No. Citizenship and income tax residential status are two different parameters. The basic test for residence is two conditions. The first condition says 182 days or more. The second condition says 60 days in the current tax year or more, plus 365 days or more in the preceding 4 years. So if any one of the basic test as per section 6 is satisfied, so the person becomes resident. A not ordinary resident who satisfies the additional conditions, satisfying the specified historical residence or stay conditions, we call them as not ordinary resident. Now, what do you mean by deemed residentship or deemed resident? So it is a special rule where if the Indian income of the Indian citizen or persons who are of Indian origin, if they have 15 lakhs in India, and their foreign income is not taxable anywhere by way of domicile, residence or similar criteria, then they can be treated as a deemed resident here. So Mr. A has stayed in India for 183 days during the tax year 26-27. What is his residential status? Mr. A will be a resident. Mr. B has stayed in India for 59 days and 400 days during the preceding 4 years. So the second condition is not satisfied. So Mr. B becomes a non-resident. Stayed in India for 60 days in the year 2026-27 and 360 days in the preceding 4 years. So now in the current year, the condition of 60 days or more is satisfied. And the second part of the condition says in the preceding 4 years, it is 365 days. So when both the conditions are looked into, that is both the subparts, the second condition is looked into. What is the issue here? He has stayed for less than 365 days. The first part is satisfied. In the first part, he has stayed for more than 60 days. That part is satisfied. But the second part of 365 days or more is not satisfied here. So he automatically becomes a non-resident. Mr. D has stayed in India for 65 days and 370 days during the preceding 4 years. So in the current year, 60 days, plus in the preceding 4 years, exceeding 365 days, equal to or exceeding 365 days. So automatically Mr. D has become resident for the tax year 26-27. An Indian citizen living in India for employment abroad and staying in India for 175 days. So whenever a person is exiting India for the purpose of employment, we'll have to check for 182 days. So here, an Indian citizen who has not stayed in India for the specified days, he has stayed only for 175 days. So automatically he becomes a non-resident. Next, an Indian citizen with 30 lakhs of foreign source income is not liable to tax in any other country and has stayed in India only for 15 days. So here, income is exceeding 15 lakhs. He has not been subject to taxation in any other country by domicile, residential status, or whatever you call. Then the person becomes deemed resident. A resident individual was a non-resident in 9 out of 10 preceding years. So automatically the person will become a not ordinarily resident. So these are the basic provisions with regard to the residential status. So you can just watch the video once more. You can just make a note of the provisions so that you become very comfortable. In a phased manner, we will just release some small topics every week with regard to taxation of salary, perquisites, and house property. So if there are any queries, I'll be very happy to answer. So thank you so much for being with us on this wonderful evening. So wish you all the best. Have a very good weekend. We will meet you in the next week with a new topic on Income Tax Act 2025, the lecture series 3. So thank you all. Thank you.
Thank you, sir.